I'm going to go ahead and get us kicked off. So, welcome everyone to the Impacts of Corporate Investment on Housing webinar. My name is Andrea Miller. I am a senior planner for the Indianapolis Metropolitan Planning Organization, or IMPO, as we commonly abbreviate it. And I am really excited to welcome you all to this webinar. So this webinar covers subject matter from the corporate-owned single-family housing chapter of our Central Indiana Housing Study. And we specifically included this sub-study within the larger Central Indiana Housing Study at the request of our many local public agencies, the cities and towns that are encompassed within our planning area. So we had many of them expressing concern about the impacts of corporate investment on to single family housing in our region. So this part of the study investigates the impacts of that on our housing stock. I'll be shortly providing a link to where you can see the full Central Indiana Housing Study, and you can look at that on your own time. But our webinar today has two components. So the first is a presentation from our speaker today, who I will be introducing shortly. And the second part will be a Q&A session where we respond to questions submitted by you, the audience. So you can submit these questions at any time. So please do so as the presentation progresses. That'll allow us to have a bank of questions to answer once Spencer concludes his presentation. But without further ado, I want to go ahead and introduce Spencer. So Spencer is a data scientist working at the intersection of data analytics, modeling, and economic geography. He wrangles data and statistical models to tell compelling stories about places, and these stories guide action. Currently, Spencer's work focuses on housing and market analyses at a variety of scales, ranging from the development of single parcels to the housing needs of metropolitan regions, including the Indianapolis metropolitan region. Thank you, Spencer, and I'll hand it off to you.
Great. Thank you so much for the introduction. I think you gave me a better LinkedIn description than I have currently right now. I love it. So as a background on me, I have a PhD from the University of Minnesota in economic geography, and I've been working at Stantec now for about 2.5 years and had the great privilege of working on this housing study. And as a metropolitan-oriented economist and geographer, it was a real interesting opportunity to look at housing and look at housing more broadly across the metro region. And as we were going through this study, we kind of started to identify that corporate investment into single family housing was a kind of big deal. And it was something that was happening not just in Indianapolis, but something that was starting to raise up into the agenda across a broad range of metropolitan regions in the United States. So, prior to 2011, there wasn't a single firm in the United States that owned more than 1,000 single family homes. And that obviously radically changed during the Great Recession, and in ways that we will discuss has been a major development across. Oh, sorry, let me share my screen. So I think today the things that we're going to be going through right in the broader agenda is we're going to do an overview of the study and the methodology. There's some elements of this, but
I'm sorry, I think something's wrong with your audio.
the data and a broad range of different data sets that we had to merge together in interesting ways to come to our analysis. Kind of look at the historical causes and how that's led to different changes in housing investment strategies within the metro area. Kind of look at the major players. So who are these large investors? Something was wrong with my audio. Sorry. Confirmed? Everything's working? Data.
Yes, everything is working.
Sorry
We have the
about that, guys.
PowerPoint, we have the
Oh
audio.
my gosh. Oh man, Zoom. It's just a little different. Okay, so yeah, we're going to be going through historical causes and then move into major players. And the major players that we'll be looking at are like who are the top 5 largest purchasers of single family homes within the Indianapolis or Central Indiana region. And then we'll be moving into ownership structure and code violations. So looking at the relationship between different ownership structures of single family homes and how that relates to the disinvestment or maintenance of properties. We're going to be looking at the same thing of ownership structure in relationship to evictions and eviction rate of single family rental homes. And then thinking a little bit about policy impacts, although we won't be doing a ton of that. Um, so in general, if we want to start, how do we define what a corporate owner is? As I mentioned earlier at the beginning, as of 2011, there wasn't a single firm in the United States that owned 1,000 or more single-family homes. But here, what we do for our definition is that we understand a corporate investor as a firm with 25 plus investment properties in the central Indiana region. There are about 98 distinct corporate owners in the region, and they own about 800 homes. And it's about 21.9% of all rental homes. So not all single family homes, obviously, but all rental homes. But 3.2% of the entire single family home stock. And if we look across the United States, that ratio is kind of in the higher, probably top 10 percentile in terms of proportion of homes that are owned by a corporate investor. Um, Secondly, so we have the top tier of people that own 25 plus properties. The second tier that we look at is an investor. And we kind of differentiate an investor from a large corporate investor as a firm or individual who owns between 3 and 24 properties. Investors, right, have always been part of the single family housing landscape. They usually historically have been local and depend either on their local knowledge of housing markets or opportunistic purchasing of properties as investment homes to rent out to tenants. They're largely, independent owner operators, but sometimes have in contract with property management firms that help to maintain those properties. But in general, they have been historically always part of the single family housing stock. And it's usually estimated between like 16 to 18% of all single family homes prior to the Great Recession were rental homes. So investors, contrary to corporate investors, own about 27.5% of total rental homes and about 4.1% of all single family homes in the region. I did see that there were two hands raised. Were those in relationship to my many technical issues in getting off the ground, or were there distinct questions that you wanted to touch on real quick?
I believe I was checking in with a couple of them. I believe that it was just because of the audio issues.
Great.
So
Yeah, that makes sense. Thanks for the heads up. I appreciate it. Um, so in general, the data sets that we used for this study were complicated, right? So we took from a data supplier, Woods and Pool parcel database for the 8 county region. And this database contained information on every single parcel within the region. And within that parcel, it had some parcel related descriptions. So it had its assessed value, an estimated market value, the number of bedrooms, bathrooms, the year it was built. This pretty standard descriptions of individual parcel attributes. Usually some kind of indication if it's a single family home, a duplex, a triplex, a multifamily property, and kind of different areas in which different distinctions within those single family homes, and then also contained ownership data on those parcels. So it contained who the owner of that particular parcel was, where their mailing address was, and the kind of mortgage that they used to acquire the home. So once we took that data, we had to identify who a corporate owner was. And that was actually extremely difficult because there's a lot of lack of transparency when it comes to understanding who owns a particular process. And if you look at Progress Residential right here, the amount of different names that they use when purchasing parcels is incredible. And some of them, there's more than 150 different LLCs that they essentially create an LLC to buy a tranche of properties. And then they create a new one when they're buying a next set of properties. So be able to identify which ones are under the same parent company. We had to understand and look at kind of particular patterns with how they describe their name, like Progress Residential Borrower with the numbers follow. Or more frequently, what we did is that we looked at the ownership address, the mailing address, and if it had the same mailing address and similar patterns, we were able to aggregate it and identify it as a particular owner. And then when we've had that owner, we would then also cross-reference that when possible with the owner's information about how many properties they had within the particular metro region. Some of the public companies had this information in public reports, while the private ones did not. So in the most part, I think we did a pretty comprehensive job of being able to identify the different LLC names to be able to aggregate under a single common owner name. But in general, there's going to be some loss in that process. The second kind of major issue when you're taking this database is understanding what's a rental home versus what's a home that's owner occupied. And to do that, we looked at two main things. The first was if it was owned by an LLC. If it was owned by an LLC or kind of corporate name and a corporate owner that owned more than 3 properties, we automatically qualified that as a rental property. And the second aspect that we would do is you would look at homestead status. So homestead status is usually a good indicator if it's owner occupied or not, but can be really unreliable in general in terms of understanding rental properties. So sometimes you can use different if the owner address is different than the residential address as a tertiary way of kind of identifying if something's a rental property. In general, this probably underestimates or overestimates the number of rental properties, single family rental properties that exist, as there could be owner occupiers that don't homestead their homes but live in those homes. What we then did is that we aggregated that data to be able to understand the total amount of owners under a common ownership name, and we crossed that data with a lot of tract level or neighborhood related information. So that neighborhood information comes from the ACS, and it takes tract sociodemographic information to understand how kind of the density of different corporate ownership relates to social demographic neighborhood related aspects. When we did the eviction data came from the Indiana Supreme Court. The Supreme Court started collecting eviction data specifically in 2021, so it allows an ease of organizing and processing data, where beforehand you would have to go through and scrape the entire kind of legal database from different counties to understand different court types to identify which ones are eviction cases. And then for code violation data, we attempted to get code violation data for the broader region, but in general, Marion County was the only one that had really organized code violation data for single family homes that could be organized by address and by the kind of code violation that occurred. And so that comprehensive database allowed us to kind of look at code violation data in relationship to ownership structure in Marion County alone. And finally, for looking kind of at changes in home ownership prices to get a more contemporary look at home prices, we use Zillow housing data. So again, with the challenges, right, there's the organizing the LICs by common name owner. It takes a long time to clean and process and organize that data. And there are not like standard data sets that exist that allow for the organization of that. Connecting address data from disparate data sets creates some data loss. So in the eviction data, the code violation data, it's not organized by parcel ID, which would be a much cleaner match, but instead by address data. And address data can be really messy sometimes because people capitalize things differently or spell boulevard differently, or things happen in that arena that makes kind of matching difficult. And so we do a range of interesting data science techniques to match those in ways that create a threshold in which that match occurs to help link those together. But there's going to be loss in that process. And again, also thinking about rental housing. Rental housing in general, there's not a clean inventory of what is a rental home or what is not, but we use this set of proxies to identify what is a rental home. So let's get into the juice of it here a little bit, and out of the kind of big questions around methodology. So again, as I've said a couple of times, there wasn't a single firm that owned 1,000 or more single family homes in the United States prior to 2011. And at the beginning of kind of the financial crisis of 2008 and the great foreclosure crisis that happened after the housing crash of 2007, there was a major issue of a large tranche of foreclosed homes that Fannie Mae and Fannie Mac had, and insufficient demand to be able to buy those homes. And so as a neighborhood stabilization program, Fannie Mae and Fannie Mac bundled together those properties and started to sell it to a range of private equity investors that had the strategy of buying those properties low. And the idea was to hold onto those properties, rent them out in the meantime, and sell them again when the property market recovered. Blackstone was the major one that was doing this, and in general, they received extremely favorable circumstances for the buying of these foreclosed homes. So first off, they were already bundled by Fannie Mae and Fannie Mac to be able to purchase those in bulk, which really lowered the transaction costs. Second, they had extremely cheap access to capital. So they were able to borrow a lot of money and raise a lot of money with very low interest rates to be able to buy and purchase these homes with cash straight up front, which kind of prioritized their ability to buy their homes. And third, it was facing a really competitive macro or not competitive macro environment where there wasn't as much home demand and a changing landscape for being able to purchase homes where there's a tightening of lending standards, which made credit extremely expensive or more expensive for other lower income or entry level housing homeowners or home buyers than it was previously. And so there was a set of circumstances that really biased the advantages of purchasing these large um, tranches of homes from Fannie Mae and Fannie Mac. About after 2012, when you started to see these kind of homes ramp up and this purchasing strategy to develop, they realized that not only could it be a profitable strategy to buy and hold, but also that buying that asset and renting it out actually proved a pretty viable capital stream that was on a pretty safe asset that could be sold at the end of that particular process. Um, and at that process, there was a kind of an emergence of understanding that this could work as an asset class that you buy and hold it and you earn passive revenue through the rents of that particular property and be able to hold on to something that would maintain value. And in a lot of places, they started to really understand where they saw that value proposition increasing. And most of the investment was happening within the Southeast and into the Sun Belt areas because those areas were projected to have really strong population growth, had kind of a lack of new supply that was coming on the market that was restricting supply relative to demand, which would increase home prices, and also had strong fundamental economic growth that was producing new jobs and generating in migration that would continue to drive strong demand for those homes. So they saw the Sun Belt in particular as a really strategic place to purchase those homes. And even more importantly, there was a greater amount of homes that were built in the kind of 2000 to 2008 housing boom that in general would have less maintenance costs, but in general are at the center of the foreclosure crisis beforehand. And so there's a lot of those homes that became available that became really targeted assets for strategic acquisition. And then again, there was still another pivot that happened in the post-COVID landscape. So during the COVID period, again, there was really cheap access to capital. So a large amount of firms that were starting to enter in the space had access to large amounts of capital at very low interest rates and started to invest in homes. And there was the secondary aspect that for the entire decade previously, there had been a lack of new supply that had been entering into the market that again was driving home prices through the roof. So it became a strategy again in that early period before housing really took off in 2021, 2022 to go out and purchase those homes with cheap capital and recognizing that there's kind of been an issue in being able to provide new supply. They kind of were limited in terms of, or saw it as a really strong strategic asset. If we look at how this happens spatially, if we're looking at corporate owners, again, this is kind of the large private equity firms that are largely based in New York City. The first wave was largely strategically concentrated in suburban and exurban areas. So it was in areas that the foreclosure crisis hit most dramatically. So it's places where new homes were being built that were overvalued, where there was kind of loans that were being offered to houses that might not have qualified under more stringent circumstances, where those home values all of a sudden plummeted in value relative to demand that all of a sudden was curtailed relative to their um, supply. And so where there was kind of a high amount of suburban foreclosures, kind of they came into that area and purchased those homes in a pretty dramatic amount. There's also a group of investors that own a large amount of properties that started to focus in on historically disinvested neighborhoods where there's kind of majority minority populations that have experienced structural racism in the form of redlining, that have devalued those homes, and where there was also higher rates of foreclosure due to predatory lending during the Great Recession. So where you had higher rates of foreclosure, you essentially had greater rates of corporate acquisition. During the kind of post-recession recovery, the strategy again continued to focus and double down on these suburban neighborhoods. So rather than kind of seeing it in urban areas where you might have a higher proportion of kind of rehabbing and gentrifying neighborhoods, this is not happening there, right? This is happening in mostly middle-class, entry-level home communities that have historically been kind of the anchor of wealth building for middle-class households. Um, and that strategy has continued and perpetuated through kind of the wave three of the new asset class. So it's something that we see spatially across metro regions is that it's not necessarily concentrated in, rapidly appreciating areas of cities, like gentrifying neighborhoods that are closer to downtown areas, but rather traditional first ring and second ring suburbs, as well as exurbs or new housing is being built, that you really see an expansion of the model. And I should emphasize here too, in the kind of wave three new asset class period, there's kind of also a transition towards kind of deeper suburban and exurban areas. And that's as a result of the transition of where new homes are being built. And in the Annapolis region, there is kind of a range of the built to rent model where home builders are building single family homes with the intention of selling them to renters as a block. But there's also just where new home building is taking place, and especially in the kind of starter home arena, that is really kind of the target for a lot of these large corporate owners. Again, this just does a kind of a clustering analysis and looks at like where there's really high rates of clustering. And if you look at this kind of where the high, that's the red, is really concentrated right in those kind of first and second ring suburban neighborhoods. And we'll get deeper into the neighborhood characteristics that they really are looking to strategically target. And this really differs from kind of investor owned homes. So for corporate owned homes, rather than investor owned homes, investor homes tend to be more broadly distributed across the city. They tend to be located more in urban neighborhoods where there might be appreciating rents or increasing demand due to gentrifying neighborhoods. But in general, the homes that investors tend to pursue tend to be about $30,000 cheaper. So about the median price of a home that's pursued by a corporate owner is about $150,000, which is pretty close to the median in general. Whereas for an investor, that median price is about $129,000. And in general, also the age of the homes really differ. So corporate investors in general are buying homes that were built in the kind of late 90s, early 2000s housing wave. And the reason for this is strategic, right? When they were buying homes, what they were interested in purchasing was a home that would require not a huge amount of rehabilitation, that were devalued because of the housing crisis. Um, and that would allow for kind of a buy and hold strategy in neighborhoods that people wanted to move into. And they were kind of identifying that within urban areas, there was continued demand from millennial populations as they aged into peak child rearing years for living in the suburbs. So where there's kind of like this myth that millennials don't live in suburbs, prefer urban areas, it's actually not true. Millennials have the same rate of suburbanization as previous generations. While they do try to prioritize and do move into suburban areas that have higher rates of amenities, they are moving to the suburbs. And they're doing so at the same time, historically, as other generations, as they kind of move into peak family raising years. So for corporate investors, it was really seen as an area that had devalued homes, that would be great for renting because they had less property maintenance requests and requirements, and would be able to be rented out in areas of peaking demand relative to the existing supply that was still constrained. So investors, right, are completely different in their organizing strategy and how they choose to invest, and that kind of plays out historically over time. So if we again look at kind of the shifting aspects relative to investors, investors again are more concentrated in urban areas, kind of areas in older homes and areas that could be where strategic homes could be purchased and sold probably for a higher rate and or rented out to kind of gentrifying neighborhoods. Um, and again, you kind of see the difference between these two, where again, you have the kind of suburban, exurban aspect of corporate owned homes versus kind of the more tightly packed and more urbanized purchasing of investor classes. In terms of thinking about this regionally, again, this is a regional issue, right? So it's not something that's concentrated in Marion County, and the regional focus is really important. The kind of share of single family rentals is extremely high in places like Johnson County, where 28.4% of all single family rental homes are corporate owned homes. In general, right, if you look at the median year built of those homes, it tends to be in like the 2005, 2002, in that kind of range, whereas Marion County has some share of older homes. And the median assessed value, right, of the corporate owned homes versus the median assessed value of the investor homes on the bottom, again, tends to be higher, and really kind of targeting like the middle income house in a middle income neighborhood and a median year built for that neighborhood is kind of the strategy, rather the kind of investor that might also have more local knowledge and local sensitivity to different housing markets, and can be perhaps more strategic in their purchasing because they're using a lot less algorithmic purchasing methods than the corporate owned homes that are doing so often quite blind and on models. But again, right, the proportion of corporate investors is really high in a lot of suburban areas compared to the investor-owned homes. Um, so we're going to just do some kind of descriptive understanding of where those are taking place. So the neighborhoods that kind of have some of the highest within Marion County are Southern Dunes and Canby neighborhoods, 5 Points, where the share of rentals is really high. So you do see some concentration, and you do see some concentration by particular owners. There's a couple larger regional corporate owners that in particular have a strategy that's based on buying older homes, in particular historically disinvested neighborhoods. Um, but then if we go through to kind of more of the suburban areas, right, Hamilton County and kind of the newer suburbs, exurbs that are outside of Carmel, where there's kind of a range of new housing being built. You see American Homes for Rent, which is the largest purchaser of single family homes in the country, really concentrating out in those areas. Progress Residential as well, and it's about 40% in Noblesville of all single family rentals. Um, Boone County in general has a pretty low ratio in general of kind of newer housing development, and there's some kind of upper middle class neighborhoods outside of Zionsville and areas around there that in general are not kind of the target demographic for where corporate owners are looking to purchase homes. So that kind of rate is generally quite low. Hendricks County, if you move east into Hendricks County and around the airport, there's kind of a really strong concentration of corporate ownership in those areas. And again, that ranges between homes built between 2000 and 2008. And they tend to be just below 75%, 25% below the cost of a median home. And again, you see concentration between kind of two of the major buyers, between American Homes for Rent and First Key Homes. Morgan County has, again, a lower rate. There's been a limited development of suburban homes, in particular during the 2000 housing boom. So the kind of areas that are really targeted by investors don't really exist within Morgan County at the same rate. Whereas Johnson County has been kind of a major center of corporate investment in and around the Whiteland area, New Whiteland, south of Greenwood. There's been a real concentration of homes that have been purchased by investors, and in some places that gets up to about 43%. So a little bit less than half of the total share of total single family rental homes. And again, the major players are the big corporate investors. So American Homes for Rent, Progress, Tricon, but also Stephen Maddock in New Whiteland. Finally, Shelbyville, there's some areas in and around kind of, so there's the historic core, but if you move to the east where there's some newer homes that have been built, there's some development or purchasing of homes in and around Shelbyville, but in general, in the more rural areas, again, it's not kind of the targeted demographic for where people are purchasing. Again, similar in Hancock as we move into these exurban and suburban areas where there was that family, similar things. So if we look at where this is taking place, right, there's some major trends that are emerging. And what we were really interested in is looking not only at what are the neighborhoods that are being targeted by corporate investors, but what are the impacts on some things, right? We hear in the research that corporate investors are essentially operating and looking at the same kind of properties as young first-time homebuyers, but are able to outcompete in that market because of their ability to offer cash. That as a consequence of that, there's a lot of people that are out of the housing market entirely because they're not able to find entry-level homes. So you'd see a decline in home ownership rates. Second, there's been some arguments that single-family homes being purchased by corporate investors is driving up the price of homes. And this is kind of a simple supply and demand aspect where if there's increased demand for the market relative to supply, that will drive up the price of homes and make them unaffordable and contribute to kind of the housing crisis that's seeing within kind of major metropolitan areas. So in particular, when there's kind of limited supply that's entering the market, an increase of demand in general, an increase of demand from, cash-rich organizations that are purchasing those and turning those into the rental market would kind of contribute to rising home prices. And third, that the ownership of properties by large corporate owners are increasing rents at a faster rate. And the logic behind that and the argument that's been made in kind of the research as well in popular arguments is that as they come into kind of a neighborhood, right, single family homes in general are going to be higher than apartments across the board in terms of rents relative to, square footage is about the same, but in terms of the overall size of the houses relative to apartments, it's going to be more. But also, as profit maximizing firms, large corporate investors are more likely to continuously update their rents relative to kind of the general market and be more savvy pricers and profit fixers than a local investor who might be more reluctant for a variety of reasons, or less informed about the market, as the corporate investor would say, about what the actual rental price is for that property. So in general, right, the corporate firms do argue that they are profit maximizers, as they should be. They have a responsibility to shareholders to deliver maximum shareholder value. So they are looking to make the most amount of profit possible off the homes that they've acquired. So they're going to be aggressively pursuing increases in rents. So one way that we wanted to look at this is to look at some of kind of the change in variables of home ownership, of rents, and median home values within particular neighborhood census tracts. And we looked at areas that had really high ratios, so ratios of corporate ownership that are higher than 30%. And we selected those neighborhoods to do a difference in means test. So we took the mean value of the targeted neighborhoods, the 97 census tracts where corporate ownership rate is greater than 30%. And we isolated those neighborhoods and we looked at the rest of the neighborhoods that did not have that particular threshold. And we conducted a one-sided t-test. So it's just a way of looking to understand if the means that are pulled from those different areas are statistically significant in their differences, right? So if you look at the variance in relationship to that, you do a one-sided t-test, and if it meets a particular threshold of the p-value, you can determine that there is an actual difference in those variables that's not related to statistical variability alone. And what we tend to see with pretty high statistical significance is that there is a decline in home ownership, and this is on some ways simple, right? That like the decline in home ownership will happen as kind of single family homes that used to be owned by owner operators are being bought by renters. But it's also very more significant in those tracks for um, Black homeowners, so kind of lower income Black households and neighborhoods that are like extremely targeted by corporate owners, as well as in kind of younger home ownership rate. So households that are younger than 35 years old, that might be a proxy for first-time homeowners. There's a much stronger decrease in kind of the home ownership rate than what we would perhaps expect in those neighborhoods as a result of kind of corporate home ownership buying. So in general, right, you do see a transition just of what could be expected already from owner-occupied homes to renter-occupied homes in those neighborhoods, and that's more severe than it is in other neighborhoods. But that decline in home ownership rates as well is more severe among areas or groups that might be competing for those kind of entry-level homes in those particular neighborhoods. So while there's kind of declining home ownership rates across the board as people are renting more due to a range of circumstances, it is accelerated a little bit in those tracks that do have higher rates of corporate investment. And this kind of supports broader research that's done kind of cross metropolitan studies on home ownership rates, that home ownership rates in general have declined faster and in those particular groups faster in metro areas that have higher proportions of corporate ownership than in cities that don't. So that kind of is supported here, and there's kind of we're doing like an intra-metro analysis here. Also, a change in rents, change in median rents is pretty significant. It's so $317 and change of rents increase versus 196 between 2021 and 2012. So there's a faster rent increase. So in general, those rent increases are more severe, again, because of that profit maximizing behavior. This supports, again, a broad range of analyses that have supported the idea that in general, corporate single family homeowners are profit maximizers and do contribute to rents that rise faster than in areas where there's not corporate owners in that particular area. So change in median home values is an interesting one. So change in median home values, there's actually less of a change in home values. So there's less of an increase than in neighborhoods that have fewer corporate investors. And in general, when the broader academic research has been looking at this, home ownership and home values relative to corporate ownership rates tend to vary based on the elasticity of housing in that market. And so when I say elasticity of housing, I'm referring specifically to the ability to add new supply relative to new demand. So in a place like San Francisco that has really tight zoning standards that can't add new supply, there's a bunch of new demand in the market, home values really shoot up, and that can be contributed to a certain element of that increase of demand from the new entrance of these home buyers into the market. In areas like Indianapolis or other places that have greater elasticity, like the Sun Belt, where they can add new housing as new demand comes on the market, you in general see less of an increase in those home values because supply is meeting that demand. And it's very rare across all metro markets to have supply meeting demand. But also there's an element here that, one, they're not operating in kind of areas where home value appreciation has been the most severe, which is in largely gentrifying neighborhoods where you do see home appreciation kind of happening at a much faster rate than you would in somewhere like a suburb or a more stable neighborhood. But also there could be impacts that is reported a lot in the media and probably requires more study to really have a determinate aspect of kind of change in neighborhood character and change in neighborhood demand. So in areas that have some disinvestment because of an increased rate of renters, and in particular corporate renters that are kind of out of the operating area of where they own their properties, there could be a higher rate of disinvestment, a higher rate of code violations or kind of property maintenance that decreases the value or attractiveness of a neighborhood, that can lower the demand for homes in that neighborhood and lead to kind of less increases in home prices. In general, if we're looking kind of like where those neighborhoods are, we can also get an understanding of where they're targeting, right? Mostly newer homes, so median year built is significantly higher than kind of the metro average, or where areas where there's not high purchasing. In general, in terms of kind of married households, right? It's also in suburban areas. So in general, there's high correlation between suburbs and married households. But also, interestingly, kind of a lower median age. So it is kind of in neighborhoods that are and still are kind of areas where you have first-time home buyers moving into that area that are kind of new, raising new households. In general, they do have some element of neighborhood stabilization, of decreasing the vacancy rate. The vacant for sale in general is extremely low, or was at the time of the study, and still is in most places as supply has been really, really limited. Okay, so we just talked through this. I won't double down on that again, but again, kind of a decline in home ownership. Home values see less appreciation. Rent appreciation is stronger due to kind of some profit maximizing. And again, this is kind of affirms some of the broader studies that have taken place in other locations, or broader studies that have taken place across metro levels. Okay, so let's talk about the who. So in this very colorful display here, I want to bring your eyes to this bottom right corner. And this is a correlation coefficient. So it takes census tracts and looks how those different variables relate to each other across the metro region, right? So we look at median year built, and or income level and median rent, right, are strongly correlated. What's really interesting in this graph to me is that you have 4 firms, and these are 4 of the largest private equity firms in the United States: Tricon, Progress, American Homes for Rent, and First Key. And if you look at their correlation coefficients, they are extremely high, blaring red, operating nearly in like extremely tight correlation with each other, right? Which kind of shows me that there's a very clear correlation in where they're buying homes. Their strategies are almost exactly the same. And so these firms that are doing this kind of activity are the large, mostly private equity based firms. And as private equity companies, they raise large sums of cash or money from investors. They go and purchase these homes, and they try to increase the value of those homes or extract value from those homes to return value to shareholders. And generally, they're very large purchasers of homes and are pursuing national strategies, again, largely in Sunbelt areas, but in some non-Sunbelt areas where they see high opportunities for increasing rents and high opportunities for maintaining value of those homes. If you kind of look at their correlation within the region here, not only do they share a similar strategy of home buying in particular cities, they share a similar strategy internally within cities of where they're looking to purchase and buy homes. So in general, right, these are kind of algorithmic related purchases that are finding an optimum place to invest in particular homes, determining on a particular price, and clicking that buy button. The other investor here is part of kind of an interesting different group, and there's kind of a corporate investors and others. And the other group, one here is Vinebrook, and Vinebrook is a large corporate investor, but they're largely regionally oriented. They're focused in Detroit, in Indianapolis, some in Milwaukee, but kind of a upper Midwest market that's kind of less targeted perhaps by the Tricon Progress, American Homes for Rent, kind of the big players. And in general, right, there's a completely different strategy that emerges for their homes than the ones that are the large corporate players. And there's a whole range of kind of large investors that are focusing outside of kind of that middle income median value home that's built in a 2000 to 2004 suburb. And instead, they're kind of trying to focus on what they would consider workforce housing. So workforce housing is kind of, rents that are affordable to households that relative to bedrooms that would be earning 80 to, 60 to 120% of MFI. They aren't, subsidized in any way, but in general, they argue within their kind of public facing perspectives that they're supplying a necessary component of workforce housing, but in general are pursuing kind of um, older homes that tend to be bought cheap, and in general have a higher level of disrepair and require kind of higher levels of maintenance if you're going to do that maintenance, but in general are trying to kind of buy more affordable homes in neighborhoods that might be riskier in terms of their investment. And in general, so there's like that other group that is kind of focusing in that band, but there's also interesting groups like IRA aggregators. So you can use your IRA to purchase assets, and a lot of those then get organized by those can range from individual IRA owner operators that buy individual homes and find and partner with corporate managers to manage those properties to kind of larger firms that purchase those homes as an asset class. So there's kind of a range of other types that have differing strategies in how they operate in the market. So one of the largest is First Key Homes, and their parent company is Cerebras Capital Management. It's a global private equity firm based in New York City. It's the largest property management firm, and they operate in 25 U.S. markets. They have more than 50,000 homes with a strong concentration in the Sun Belt. In general, if we look at the homes that they're buying, right, the median value is about $167,000. The homes that they're buying is in that again that range between late 90s, early 2000s. They became really active in the housing market once kind of the asset class got established. They weren't really first movers in that post-recession era. But in general, they do tend to have pretty high rates of code violations with like 12.9 code violations per 100 properties, and also strong evictors with 25.1 evictions for every 100 properties. Another big player, again, corporate investor, is American Homes for Rent, and this is one of the big first operators, and it's currently owned by actually BlackRock Financial. I think just um, sold the firm, but they own about 23,000 homes across 18 states. They own about six. Yeah. Oh, that's some contradictory information here. But if we look at kind of where they are purchasing homes, again, it's the same range, right? Like these corporate strategies are very similar in how they're pursuing properties, but they have a much higher eviction rate. So 44.9 evictions filed for every 100 properties, but kind of lower code violations. I think if you look at kind of the median year built, you start to understand that they're buying homes that in general are going to be in good repair, that need minimal repairs, and aren't buying older homes in more disinvested neighborhoods that might need higher repairs. And a lot of them argue that they're extremely strategic in how they purchase homes and have a major advantage because they're able to repair and put homes back on the market faster than other firms because they have access to capital, which is something we'll put to the test. Progress, again, is another one, and I love this quote from the CEO. We want to buy a 2,000 square foot house built in the 21st century, preferably in a homeowners association, with a two-car garage, a front and a backyard, and not on the corner. So it's like clearly it spells out what the strategy is and how they're purchasing homes. In general, they've come under investigation in a lot of different spaces. They have pretty low code violations, right, relative to what you would expect, but much higher eviction rate. So the corporate model in general has a higher eviction rate. They've come under pressure in places like Minneapolis for evictions in relationship to substandard properties. Um, and then if we get to kind of one of the other firms, this is Vinebrook. And if you look at Vinebrook's strategy compared to, say, the typical Progress Residential, right, their strategy is much more concentrated in historically disinvested majority minority neighborhoods. If you they've have a pretty bad reputation in general. They've been sued in Cincinnati and Milwaukee and Indianapolis and Cleveland. They've kind of become a face for some of the more poor operations of these firms. And in general, right, pretty high violations and pretty high eviction rate. But if you look at kind of the median assessed value, right, it's almost half the cost to some of the corporate investors. In general, kind of a lower average rent compared to some of the average rent of like American Homes for Rent, that's around 1750. And in general, if you look at kind of the age of their homes, that it tends to be significantly older homes. Tricon's another large one. I won't go too much more into depth. I think you kind of get the general trend, but if you're looking back and interested in seeing the relationship between some of the things, there's some correlation between those. So now that we kind of understand where they're investing, the next thing that we kind of want to dive into here is looking at code violations. And in general, there's some element of investment or aspects from what these firms say that they're buy these homes, they invest in them, they repair them, they keep them on the market, and they stabilize neighborhoods. They should be seen as an asset because they are responsive and are able to mobilize a large scale of professionals to maintain a property. But on the other hand, there's a lot of public reporting and general information that comes from other locations that indicates that they can be negligent out-of-state owners that aren't responsive to tenant requests that in general have poor maintenance of their properties. So we're interested in kind of testing in this, how ownership structure relates to and impacts code violations. So if we look at code violation data, again, we took this from the Marion County Department of Health, and that data was taken from 2013 to 2023, and then linked to particular parcels, and then linked to ownership data via that parcel linkage and the sale ownership. In general, we excluded any parcel where there could have been a violation and the last sale date of that property didn't align with the most recent owner. So we made sure that the code violation occurred at the time it was owned by that property owner. And then it's the general universe is single family homes. So if we think of code violations more generally and where they happen, there's a really strong statistical correlation and bundling, and it aligns almost perfectly with historically redlined neighborhoods. So the map on the right there is historically redlined neighborhoods. If you see those red areas, those are areas that were redlined and made it extremely difficult to get home loans, made it extremely difficult for people to purchase homes in those areas through kind of federal programs. So it's a generally exclusionary aspect that targeted Black and brown neighborhoods. And generally, you have really high rates of disinvestment in those neighborhoods that lead to kind of higher rates of property decline and dilapidation that occurs as a result of that lack of investment and the ability to access capital to invest in those spaces. If you look at code violations, right, we looked at kind of the major big players, and they tended not to be very high in terms of code violations for their properties because, as we said, they really did target those newer homes. And if you look at this graph, the dark red in general are older homes, the lighter red are newer homes. And if you look at how it's organized here in code violations per 100 properties, you tend to have these really, bad operators, and they tend to be operating in spaces that are in older homes and different neighborhoods than kind of the large corporate players. And you have some, really kind of high rate amongst the RA club. You have some pretty high rates along Vinebrook Homes, which was kind of that one that had been brought up earlier. But in general, it tends to be First Key Homes is still in here though, and Front Yard Residential, American Homes for Rent. But in general, right, the correlation is pretty strong between age of the home and the number of assessed values. So we did to kind of model and look at this is we did a regression called a logit model, and that regression model attempts to understand or model the odds of a property having a code violation. So you take a range of parcel specific information, so the age of the home, the amount of code violations within a mile and a half radius of that particular home. You take the assessed value and the property condition of that home as it's been measured within this data set. And then you take neighborhood level properties like the income level, so the relationship of the median household income relative to the regional median household income level, home ownership rates within that broader neighborhood in which it's embedded, presence of minorities, so in terms of proportion of people of color within that tract, neighboring violations again, and poverty rates, the proportion of people in poverty. And what this does is it essentially creates a model that would predict whether a home would have, it would get a 1 essentially if it had a violation and 0 if it doesn't. And without a doubt, the largest contributor and largest factor for understanding code violations is whether it's owned by a corporate investor. And the odds factor that you see below, a 3.521, means that, let me go over here. So in general, what ownership really structured. Okay, so this takes the odds ratio variable for that particular model. And essentially, if the odds factor is above 1, it increases the odds of a house having a violation. And if it's below 1, it decreases the odds of what we would predict for there to be a violation. In this particular prediction, right, if every income level that's above the median income level, it decreases it by about 0.2%. For every assessed value in $1,000 above $0. So it decreases by 1% the odds of a particular parcel having a code violation. The largest aspect is whether it's corporate owned or not. And a corporate owned home has a 270% chance higher rate of increasing a code violation. So it increases the odds by 3.2, which is a very dramatic increase and a really strong correlation between the ownership structure and the odds of a home having a violation. Investors are also very likely to have code violations as well. And a lot of those investor-owned homes, again, are kind of in older homes in kind of more historically disinvested neighborhoods. And other kind of major contributing factors, right, are the poor condition of the house. So, the external look of the house and how it's been maintained. And that's kind of a ranking that assessors do, and the age of the property. So they increase with the age of the property, which makes sense. And there also is some spatial clustering. So as the number of neighborhood violations goes up by 1, there's a 1.3% increase in the odds of that having a violation. But in general, an odds ratio variable of 3.2 is really high and is statistically significant and shows that there's a very strong relationship between ownership structure and the chance of a property having a code violation. So we did a similar study for evictions, and we're looking at evictions using the case data that came from 2021 to 2023. In general, again, we took the defendant address data. So the defendant is the place of where that eviction is taking place. So we could take the defendant address, link it to the property database, and then link it to the owner via the property database. And that's how we were trying to understand the relationship between evictions and ownership structure. And in general, eviction trends here in the kind of central Indiana region are very similar to trends that are being reported nationwide, where there's a big movement of those from kind of urban areas into suburban and exurban areas. And that's also strongly correlated with where you do tend to see these investments from corporate owners. In general, there's kind of an acceleration from 2021 into 2022 in eviction rates, and then kind of a slight decrease that started to happen in 2023. And that's pretty tightly correlated to rents. So rents were appreciating by 11 to 12% in that 2022 period. And because of that, you had really strong incentive for landlords to kick out people that may be underpaying or not paying their rent, and to get new renters into that space to be able to increase that rent rapidly. Whereas when rents started to go down, vacancy rates started to increase, there's kind of an incentive to try to maximize the amount of value from those existing tenants and to work with tenants to try to come to a different solution rather than using the eviction tool. So in general, that relationship is pretty strong in terms of looking at rent growth and vacancy rates and eviction rates. But in general, there's been kind of a strong increase. There's tough to get a baseline on eviction rates from pre-pandemic area. So we used a range of different data sets to try to triangulate that. And there was kind of internal inconsistencies there as well. But in general, what we see is an increase and nearly a doubling in some counties, like in Johnson County, more than a doubling of the eviction rate. And kind of a stronger increase in most of the suburbs relative to kind of the urban areas. This kind of looks at its organization and doesn't give a ton of, if you normalize it by homes that had an eviction filed, it tends to show some increase of concentration, kind of the first ring suburbs area. And then in general, what we did too is we looked at the relationship between, in modeling it, similar to we did with code violations and where evictions happen. This is kind of a correlation coefficient. So in general, evictions tend to be higher with a higher ratio of corporate single family homes. So it's pretty strong correlation coefficient there. Higher correlation coefficient with minority presence. So it's kind of the increase in diversity in the census tract exists. It's strongly correlated with evictions. Poverty ratio, so right as the proportion of people in poverty increases, evictions also tend to increase. And there's strong kind of negative relationships between the median assessed value and the home value, and between kind of the home ownership rate and the amount of people with, with higher incomes and kind of more education. So it's a pretty strong dichotomous relationship between those. In terms of evictions per 100 properties, corporate investors are far more likely to evict. So they average 17.1 mean evictions per 100 homes, where investors are at 6.2 and non-investors are at 1.3. And this is kind of a list of some of who the major evictions are per 100 properties. Indy 500s and other Terra Capital are similar in both of the eviction data and the code violation data. And we did a similar model, again, looking at kind of the consequences and impacts of ownership structure, as well as some of these neighborhood values on eviction rate. And again, it comes out that corporate investors are far more likely, if it's corporate owned, are far more likely and the greatest contributing factor to understanding of the odds of a property having an eviction rate. So there's pretty strong evidence, right? It increases the odds by 52%. Whereas really interestingly here, an investor-owned home has a negative relationship and a pretty strong one. So it decreases the odds by 14.5% of the house having an eviction relative to a standard non-investor-owned home. So mom and pop actually might be more likely to evict than an investor-owned home that owns between 2 and 25 properties versus kind of corporate-owned home that are far more likely to evict and rely on the eviction tool. Other aspects, right, are property condition, so it increases the odds by 5.1% in the proportion of minorities within the neighborhood. As that increases by 1%, it increases the odds by about 0.7%. So if we kind of look at the code violation and eviction data together with where this is taking place, is that ownership structure does matter. Ownership structure does tend to increase the rate of evictions, the rate of code violations, so the lack of property maintenance within those areas, and does tend to have an impact. And if we look at the actual data here, there is a far more likely chance that they're willing to evict, far more likely chance of there being a code violation on the home with kind of these large owners that are owning and operating a large amount of rental properties. So that does show that there is kind of a lack of responsiveness to those tenants and a willingness to rely on kind of the court system and more formal mechanisms of removing a tenant that's behind on rent using an eviction. So really strong profit maximizing behavior that looks to, in particular, in areas where they can maximize that by getting a new renter in and bump that rent, do so within their particular operating standards. So profit maximizing here is tightly related to kind of evictions. So if we're thinking about some potential solutions, a very big one is expanding tenant protections. There's a really strong correlation between the extent of tenant protections that exists and the rate of corporate ownership. They've been very explicit in some of their public meetings and public calls that they target areas that tend to be very favorable in the legislative environment for landlords. And so in that balance of power, they do tend to invest in areas because they see it as their strategic asset to maximize the value of those homes in areas that in general favor the interests of landlords. And there's some pretty standard policies that have been generated in a lot of places. So one is the right to withhold rent. So places that allows the tenant to withhold rent payments in the case of a code violation or the case of a repair that's not being made in the house. And being protected from eviction in the case that happens. the right to repair and deduct. Indiana is one of 11 states with no such law. The right to a defense attorney for evictions, so the ability to have a defense attorney rather than getting an eviction straight on your record, which deeply impacts your ability to find future housing. An eviction ceiling, there was a House Bill 1219 that recently attempted to address the issue and received pretty strong bipartisan support. So in general, like a pretty simple one is understanding and recognizing that, corporate investors might be here to play, but understanding and increasing the ability to expand tenant protections might be a really strong way of increasing the rights of tenants within those spaces to prevent abuse by bad actors. Another program that's been really popular in some areas and relates to kind of the previous housing crisis, there will probably be another housing crisis in some future, is understanding a program for sales and first look program sales. So instead of kind of selling, um, homes that are foreclosed to investors in the bulk program that was similar to what happened in the previous one. Instead, those could be sold to nonprofits or other kinds of investment classes or NGOs, increasing the window and the ability to buy those or prioritizing that strategy. There are some cities that also, when they're selling kind of assessed, properties where people haven't paid their taxes, county sees properties that they prioritize nonprofits and prioritize people that have a good rental standard in the resale of those properties or prefer owner occupiers. And the second aspect is increasing access to home improvement loans. So a big aspect of corporate owners is right that they claim that they have the ability to go into homes and be able to repair them and put it up to rent. But the smaller owner operators that may be more responsible owners of rental homes or maybe more responsible owner occupiers don't have the same access to capital to repair properties and to improve them. So they are less likely to take a gamble on purchasing a house that needs work and then be able to improve it and then manage it in a way that's responsible. So increasing the ability to have those loans can make more responsible, help people or smaller investors make more responsible decisions. And I think the biggest aspect, again, is expanding rental housing of all types, right? So increasing supply and recognizing that, people will be renting and that these actors are here on the market. You want to increase the incentives as much as possible to have people act in good faith. And a great way to do that is to make sure there's an adequate and abundant supply of housing. So rents aren't out of control and vacancy rates aren't too constrained, because in those conditions where vacancy rates are extremely low and rents are growing strong year over year, it gives landlords very little incentive to improve their property and to maintain strong relationships with existing tenants because they know that they'll be able to get it filled and be able to get it filled at a higher rate. And so if you have more abundant housing that's available and you have kind of lower vacancy rates, that really enables or puts pressure for landlords to improve their properties, to make sure that they're competitive on the market, and to enable or allow renters greater options and choice in the market. So yeah, this is, again, leave this on kind of the final page, but I'd like to end it here. I kind of hit the 45, 50-minute mark. So yeah, open to any questions or discussions or things that we can go to from here. Thank you again, for listening to me talk for a little while on this issue. It's something that I care deeply about and I'm very interested in. But yeah, I would happy to discuss methods or results or other research.
Thank you so much, Spencer, for that presentation. Lots of great information included. I do see one question that has been submitted, which is how much of the affordability gap in central Indiana can be attributed to corporate ownership? Is that influence trending up, down, or holding steady?
I would have to study the to get like a specific quantitative impact in the affordability gap, but I think what we are seeing is for renters, right? The affordability gap is pretty strong in terms of rent burden households as a result of corporate ownership. But corporate ownership in general in the single family market is still a pretty marginal percentage of the entire rental market, but it is a strong contributor, but not the central contributor. The strongest contributor to the affordability crisis is a lack of housing supply. So while it is a contributor in increasing the demand and increasing the rate of rental increases, the ability to increase those rents and the ability to charge higher values on those houses is a function of supply.
Right. Excellent question. Thank you. I don't see any others lined up. I'm going to give, oh, here we go. We have another question. Is there hope for this to get better? Have you seen any metro areas overcome this issue? So looking a little bit outside of central Indiana.
So there's still pretty strong incentives in tailwinds for corporate investors to invest in the housing market. In general, again, the supply issue hasn't been solved, so there's still lack of developers in new single-family homes that are coming on the market. As long as the supply isn't really expanding at the rate, the 4 million homes that are estimated to be needed, there's a strong incentive to buy those homes and be able to rent them. The tailwinds are also strong in terms of increased amount of millennials that are in their prime child rearing eras that will likely also be renters. So there's a strong incentive to continue to provide the housing stock that might be more desired by young families that might have higher rates of household debt from college degrees or a whole range of factors that might prefer renting rather than owning. And so there's also kind of a strong demand for increased rentals. What cities are considering and thinking about is considering regulating in a deeper fashion how that takes place. So you can do some places are considering, like in San Diego, are considering a much stronger rental licensing program, and that rental licensing program would require a common owner to be identified of that program and to be able to identify their behavior as a landlord to make that a little bit more transparent in terms of the evictions and code violations that they have, as well as kind of penalize those bad actors through increased fines or the refusal to give a license or revoking of licenses as a result of poor property management. So increasing the regulation of that market is another strategy. And then in some places like California, are considering kind of outright bans in who can operate in those spaces, but nothing has been passed in that regard in any major metro yet. There's pretty strong, political forces in that arena that are shaping that. But in general, it's a pretty hot issue. And I think what I would try to maintain as an aspect here is like this kind of also gets blamed a lot as like a hot button issue as the cause of the housing crisis and the cause of increased home prices. And I think that's misplaced. I think in general, there's going to be bad actors in this market, and they're obviously profit maximizers, and they're, all obviously, rely on some tools that are available to them to maximize their profits. Um, but in general, the general conditions of home building and availability of housing supply continues to be the major issue facing that market. And if you had abundant housing that was available and you had kind of a greater supply of housing, the incentives really do shift away from kind of more milking of properties and profiteering. So while it's a contributing factor, there's probably unlikely to be any strong legislation on kind of the state level to kind of ban that kind of behavior. But California is kind of banding around some ideas right now.
That's actually a great transition into our next question because you said there's no real movement at the state level. But the following question we have is there a significant effort to address this at the federal level? Have you heard of anything, Spencer?
There's a lot of studies that are going on to understand what the issue is, and the studies are important because um, the large corporate investors, when they're release their public statements, are saying that we only own 3% of the housing market or 2% of the housing market, even though they bought 26% of the more recent homes in the last couple of years. So they say that we're a tiny percent of the total rental market, we're a tiny percent of the total housing market, our impact isn't very large. And they say in the public that there's no data that supports the fact that we're like bad actors, we're like great, we stabilize neighborhoods, we invest in neighborhoods, we provide necessary services and housing for populations. So there's really contradictory information. And I think like a study like this is a pretty good step in terms of like understanding how they operate differently and where they're operating. So there's been studies that have been commissioned to understand kind of their overall impact. In general, there's kind of some effort at the federal level to, um, there's a lot of bluster around some of the issues and recognizing it's an issue, but it's very unlikely at the federal level that anything's going to get passed that will regulate this. I think what they're focusing on in terms of their general housing policies, um, right, depends on which party you look at, but in general, they're both supply related issues, and they don't see kind of regulating corporate housing as the major issue. But yeah, in general, there's not very good general policies on either side to address this as a particular issue or to track it or to look at it in a more systematic level. Like there's some pretty simple ones, right? Like if you common ownership of LLCs would be a simple one that, being able to track who they are and what they're doing. But there's not even things like that. So in general, right now, I'd say that the movement is very slow and unlikely to move anywhere in the near future to counterbalance the kind of growth of this industry.
All right, thank you. The next question we have is, are renters more likely to report permit violations when they are renting from corporations versus mom and pop investors where there might be a closer relationship?
That's a great question. I don't have data that supports it one way or the other. There's been one study that's a really great one in Milwaukee because they have this really just fantastic database on code violations. That's like sets the standard. And what they do find there is that code violations, and this is like in the general literature, is that code violations only get reported after usually a tenant has pursued a range of primary steps. First step is contacting the landlord, seeing if it gets responded to, contacting the landlord, seeing if it gets responded to. In the case that doesn't get responded to, then they're like, as a last resort, contact an agency to get that kind of reported and fixed. And so the general theory here that we would test, right, is that the non-local landlords are going to be less responsive to tenant requests for improvements. And from this data, I would say that there's general support that like these large corporate owners receive more code violations because not only, are there some of their properties may be in disrepair, which in general, like the large big ones shouldn't have that issue because they're buying newer properties. But in general, they do seem to be less responsive to the tenant requests compared to the small landlords. So they would be more likely to report it compared to a smaller investor. I think like that's the logic I think plays out, and I think it's kind of supported by the data, but there hasn't been a ton of kind of qualitative data to see if it would occur more or less because of them being aware of who their owner is. Does that make sense?
I think it makes sense. We have a question. It's a little bit vague, so for whoever typed this question, it's an anonymous attendee. They just said violations versus actual property conditions, question mark. I'm not sure I follow the question, so I'm gonna pass that one for now. But if whoever typed that wants to clarify that. Oh, I think it's coming in right now. Or maybe it's a follow-up to the last question you answered. I'm going to keep going, but whoever said violations versus actual property conditions, question mark, if you can just provide additional information, we'll be happy to answer that for you. So I'm going to go
So,
along. So, did you have a thought, Spencer?
There's another question or time to clarify.
Yeah, I see that. So it said, question for either of you on if supply is the issue, do we know the largest obstacles there in our region? And clarified that this was more about the larger housing study, right? So this webinar obviously focused on corporate investment into single family housing. I'll go ahead and I'll, provide my opinion on it. And then you can also follow up, Spencer. In my opinion, as a planner, I believe that the largest obstacle to housing issues in our region are zoning ordinances that do not allow for a more diverse and affordable types of housing. So I refer to things where for example, the lot size has to be a given size, and you effectively prevent a lot of those more affordable housing options like duplexes, quads, courtyard homes, those types of housing. However, I also want to point to the fact that the reason those zoning ordinances exist is because of public opinion that informed them. Essentially, the community said, we don't want this type of housing. So on a surface level, you could say, oh, we need to have zoning ordinances that allow for more diversity and more affordable housing, but at the core, it comes back to a community issue. Let me know your own thoughts, Spencer, on that.
So I think that's a clear one. I think you're right. If you look at a place like Minneapolis that has loosened its zoning regulations to increase a higher density and diversity of housing, Minneapolis has added more units relative to population than other locations and has had, when other rents were increasing by 10, 12% year over year in the last couple of years, Minneapolis rents have been pretty flat. So there's a pretty clear relationship between kind of zoning and housing supply. I'd say some other things that are a little bit trickier that may not necessarily be clear is that after the financial crisis, there was just a huge wipeout of small and medium-sized developers, land developers, and builders. And because they were highly exposed and had a lot of risk and, largely failed and went bankrupt, there was a wipeout of this entire kind of spectrum of home builders. And they build a range of things from single family homes to duplexes to triplexes. But in general, those kind of like middle developers and kind of smaller developers just were eviscerated. And there's big changes in the banking structure of who finances new development. And so the big players get to, essentially build homes. But it's just completely inadequate relative to total demand. And there hasn't been kind of a replenishing of that supply of developers to build housing. Another big one with single family homes is cost of municipal services. So building infrastructure used to have greater subsidies and allow for cities to take more risk in developing it, or developers to take more risk. But in general, developers have shown a bigger risk intolerance to developing infrastructure, which really slows both the density of housing that can be developed and the amount of housing that can be developed. So partnerships around that have become really important, in particular in suburban and exurban areas. So those are kind of the major issues.
All right, great follow up. I am not seeing any more questions. So I think our webinar has come to its conclusion. If anyone does have any follow up questions that they think of after the fact, you can email me at andrea.miller@indynpo.gov. And we'll do our best to answer them for you. But thank you so much for joining us today, and we hope you have a great day. Thank you so much, Spencer, for taking the time to make this presentation and answer some of our questions.
It was a privilege. Thank you.
All right. Have a great day, everyone.